Hello, everyone. Welcome back to Financial News, and I'm Ron Jankowski with Channel 4. And of course, we have Paul Munichel from Ameriprise Financial that's going to give us an update as to what took place in the marketplace and additional news. Paul?
Thanks, Ron. Today we're going to talk about home prices, and in particular, new home prices that are beginning to moderate. And we see that as potentially a good thing. The Census Bureau will release its data on new home sales for the month of October on Tuesday, tomorrow. Forecasters are surveyed by Reuters expect sales to remain at a fairly strong level of just over 700,000 units on an annualized basis. However, the median selling prices of new homes sold in the month could show some further slippage. While this may draw comparisons to the housing bubble experience when new home prices were falling due to weakening demand, the recent moderation in median home prices is primarily reflective of an improving mix of sales. This is a positive development relative to the need for more affordable housing units. Put differently, sales at lower, more affordable price points are improving, as builders are finally constructing more units at these levels. In the years following the Great Recession, builders that survived focused on building large, expensive homes where they could capture the largest profit margins. As availability at upper price level points is now ample and seeing greater price competition, builders are slowly focusing on adding supply where it's needed most. In September, 50% of all new homes sold were priced below $300,000, the highest share for homes in this price range since February 2017. So all in all, the report's telling us the housing market, although maybe moderating, the demand may be moving to lower priced homes, which might not be a bad thing for the market and the economy. We'll give you further updates as we get them.
And also this morning, the morning research notes have been submitted by Ameriprise Financial as well. And here are some of the notes that they have given us to share with you. The S&P 500 index futures are higher this morning amid increasing expectations that China and the U.S. can reach a phase one trade deal.
Yeah, and that's a story we've been talking about on the show for over a year. It's in the news always. The market is pricing in a deal, I believe, but it still needs to get done. So hopefully we can get some progress on the trade talks.
And they also mentioned that the yield on the 10-year Treasury is higher to around 1.79% as investors weigh comments from the Fed Chair Powell.
Always waiting to see what he's going to do with interest rates. We know we've cut a few times this year. There is debate on will we see one more cut this year or potentially some cuts in the next year. And we're just seeing the Treasury markets move on expectations.
Right, and they always do. That's the normal thing. Hong Kong's Hang Seng Index rallied 1.5% overnight after pro-democracy candidates won 85% of the open seats in a landslide victory following a record voter turnout. That was interesting to hear that.
It's great. It's always good to see the global markets improving along with ours.
Yeah, exactly. And a comment about Tiffany. I'm sure everyone knows about Tiffany jewelry. Tiffany agreed to be bought by France's LVMH company for $16.2 billion and or $135 per share in cash. I would like to have several thousand shares of that.
Wouldn't be bad, and I think based on that news with Tiffany, you should maybe go out and buy your wife some Tiffany jewelry for holidays.
We're doing that just this afternoon. I'm kidding, in case she's watching. The other morning research notes also have been sharing with us the S&P 500 is a plus 26% year-to-date. Dow Jones a plus 22% year-to-date, and the NASDAQ Composite 29% year-to-date. Still holding, Paul?
Staggering numbers.
Unbelievable. Anything else you want to add?
No, it's we are coming into the month of December, as everyone knows. It's crazy how fast this year has flown by. Remember last year's December was really rough for the stock market, so hoping this year we can just hold on to these gains that we've made.
Right. Now, I want to mention, if I haven't already, that this report that we are giving is as of today, November 25th, 2019. Stay with us. We'll be right back. Paul's going to be talking about your 70-and-a-half-year-old tax requirement distribution that must be taken. He's going to give us some input on it. Stay with us. We'll be right back. And we're back with Your Money. As I had mentioned, Paul is going to be talking about once you turn 70 and a half, there's a tax requirement that you really need to know about. It's called RMD. And Paul, explain what RMD is and take it from there.
Absolutely. So if you are at the age of 70 and a half, you may be required to start taking these required minimum distributions from your tax advantaged accounts, IRAs, 401ks, etc. So I prepared some questions and I've got some answers to just kind of go through this. Hopefully these are the kind of questions that I frequently get asked, so I've given them to Ron to ask me, and we'll do it live right now.
Okay, your first question is, what are RMDs?
Required minimum distributions is what RMDs stand for, and they are for your retirement account withdrawals. They're mandated by the IRS. Once you reach age 70 and a half, by requiring you to withdraw a portion of your retirement savings, the IRS is able to tax the income that has been allowed to grow tax-free.
Paul, what kind of accounts actually fall under this federal tax requirement?
Yep, so RMDs generally apply to all tax-deferred retirement accounts, including traditional IRAs, SEP IRAs, and simple IRA plans. An inherited IRA is also subject to these rules. Roth IRAs are exempt from this requirement because they are funded with after-tax dollars.
And of course the question is, obviously, when do I need to withdraw RMDs?
Right, so when your annual obligation begins, once you reach the age of 70 and a half, in the year you turn 70 and a half, your first RMD is due by April 1st of the following year. Thereafter, you must withdraw your required amount by December 31st of each year. The only exception to the rule is that 70 and a half rule. If you're still working and participate in a 401k profit sharing or 403b or other contribution plan, if you can, those distributions change, so you will want to work with your advisor on that if you're still working and contributing beyond age 70 and a half.
And then how are RMDs actually calculated?
Yep, so they're calculated based on your life expectancy. The IRS provides life expectancy charts and worksheets to help you determine how much you need to take from your IRA. The calculation is different if you participate in defined contribution plans. However, your plan administrator will often calculate your RMD for you in that case. Your financial advisor and or tax advisor can help you plan for and make the appropriate withdrawals to meet your requirements.
And what if one owns multiple accounts?
I get this question a lot. So once you reach 70 and a half, each eligible account will have to calculate an RMD requirement. If you own multiple IRAs, you can choose to add up the RMD amounts for each account and withdraw the total from just one account if you choose to, or you can take the amount from each individual account. All that matters is if you take the right amount.
And so you cannot take the same amount every year, then that it fluctuates.
Exactly. So every year your RMD needs to be recalculated. You use the balance of your accounts as of December 31st in the prior year. You use that balance, then you use the IRS table based on your age to calculate what you have to withdraw.
Okay, then there are people who are going to say, what if I don't take that withdrawal? What happens?
Hopefully no one falls into that situation, because ignoring your RMD, you can have had some costly penalties to it. A skipped withdrawal may be taxed at a 50% penalty. So if you miss a deadline or miscalculate, consider withdrawing the required amount as soon as you realize the mistake, and let your tax advisor know right away.
Actually, it's really not favorable to ignore this.
No, you want to make sure you miss it. A 50% penalty is a steep penalty. It's your money. You have to take it anyway.
Right,
Let's just get it out on time.
And what can you do with that money?
Yeah, I advise clients this all the time. You have to take it out. But of course, you don't have to spend it. You can take it out, save it in your savings account, or put it right back into another investment account, just not a tax-advantaged one.
And I would imagine you could also donate it to charity.
Absolutely, and that's something to consider. Work with your tax advisor on that. You may be able to donate directly to a charity, and potentially you might be able to avoid some of the taxes that way. So charitable donations directly from an IRA is something worth considering and talking to an advisor or a tax advisor about.
Boy, that's really important. You do sit down because your portfolio could vary from year to year, and it would be to your advantage in some cases to donate to a charity to reduce your tax.
I've got clients that do
obligation.
it. Money comes right out of their IRAs. They never
Yeah.
touch it. It goes directly to their charity of choosing, and it often helps them in their tax situation.
In general, is there anything else you want to add to this topic, Paul?
Just in general, when you get 70 and a half, start talking to your advisor. Actually, before you get 70 and a half, talk to your advisor, talk to your tax advisor. Make sure you're calculating the amount you have to take, and just get it done by December 31st. That first year, that first time, you've got a little bit of extension until April 1st. Most clients don't push it off that way. They just get on the schedule of December 31st every year. Take it. You don't want that 50% penalty.
Yes, exactly. Well, that would be really crazy to ignore this, and you really need to pay attention to this. And most of all, you need to schedule yourself with a tax advisor and a financial consultant working together to accomplish the right thing.
Exactly, and this is my role. I mean, again, we've talked about taxes today, but I'm certainly no tax advisor. So anything that comes to taxes, please talk with your tax advisor first about it.
There's a question further about the program. Is there someone, or you could be called?
Absolutely. You can call me directly at my Ameriprise office here in Orland Park. I'm at 708-226-3412.
All right, Paul, thank you again for bringing this program. This is really, really interesting and important. So for Paul Munichel with Ameriprise Financial, myself, Ron Jankowski with Channel 4, we both wish you good investment day.